week's market update. Central banks around the world turn more cautious. The latest British growth update suggests they're right to be so. Meanwhile, markets rise on hopes for US-China trade talks. The big market story this week was not Donald Trump's State of the Union boast about the unprecedented economic boom since he became president 2 years ago, but the coordinated retreat from tighter policy among the world's central banks. They can't both be right, of course, and the fact that Australia, India, the Bank of England and of course the Fed are all singing from the same hymn sheet means the safer bet is probably to believe the bankers. Within hours of Trump's speech, the governor of the Bank of Australia was warning of an accumulation of downside risks. That was followed by the Reserve Bank of India bowing to pre-election pressure from Prime Minister Modi by cutting interest rates by a quarter point. Soon after, the Bank of England ditched its own plans for multiple interest rate hikes. Those three came hot on the heels of the Federal Reserve's decision at the end of January to shelve further rate hikes because of the impact they could have on what is seen as increasingly fragile US growth. The picture this year is notably different from that a year ago, when business leaders in Davos were trumpeting a broad and synchronized upturn in growth and confidence. This year, forecasts are going the other way, with the IMF predicting a slowdown in developed countries from 2.3% last year to 2% in 2019 and just 1.7% in 2020. The IMF's new chief economist this week praised the Fed's newly cautious approach, saying it was right to be easing back on tightening. There are several reasons for the economic slowdown. Top of the list is the ongoing trade spat between China and the US, which has started to hit confidence around the world. Although the US domestic economy has continued to fire on all cylinders, American companies are not immune to slowing demand in the rest of the world, and the tougher outlook is starting to show up in slowing earnings growth. Evidence of the slowdown is appearing all over. In Australia, house prices in the two biggest cities, Sydney and Melbourne, have fallen 12% and 9% respectively. There are forecasts that the slide could hit 25% before it bottoms out. Closer to home, the European Commission has cut its forecast for growth in the region from 1.9% this year to just 1.3%. And last week, numbers out of Germany, the engine of European growth, were notably poor. And then this week, the UK added to the gloom with a sharp fall in growth in the fourth quarter of 2018 from 0.6% to 0.2%. That took the growth for the full year down to just 1.4%, and that was the lowest rate of expansion since 2009. The Bank of England has warned of further problems ahead, with a 1 in 4 chance of recession in Britain by the summer. Economists are clear about what is causing the slowdown. Brexit-related caution is showing up in the latest data, with industrial production contracting and business investment falling for the fourth quarter in a row. The pound, which has held up well in recent weeks despite fears that Britain is heading towards a damaging no-deal Brexit at the end of March, fell to a recent low of less than $1.29. As is often the case, a disconnect has opened up, however, between the health of the economy and the performance of stock markets. A year ago, against a backdrop of high expectations for growth, fueled by Donald Trump's tax cuts, the stock market turned negative, looking through the short-term sugar rush of growth to the hangover that investors assumed lay around the corner. This year, by contrast, even as growth expectations turned negative, stock markets have continued the strong performance they put in January, when the market weakness of the fourth quarter of 2018 was rapidly reversed. The main positive driver for stock markets in recent days has been expectations for progress in the China-US trade talks, which resumed this week as Robert Lighthizer, the US Trade Representative, and Stephen Mnuchin, the Treasury Secretary, went to Beijing to meet Vice Premier Liu He. The rally in European shares on Monday picked up on a strong performance in China as traders returned from their New Year break. Trade remains a potential headwind, however, after President Trump ruled out a meeting with his counterpart Xi Jinping before a March 1st deadline to resolve differences ahead of the imposition of 25% tariffs by America on about $200 billion of Chinese exports to the US. In last week's State of the Union address, Trump said any deal with China must include real structural change to end unfair trade practices, reduce our chronic trade deficit, and protect American jobs. The uncertain nature of the trade talks did not stop foreign investors pouring a record $9 billion into Chinese equities in January, though. That was the largest one-month inflow ever, with investors betting that the terrible performance of Chinese shares in 2018 has now run its course. The CSI 300 index, which tracks blue-chip shares in Shanghai and Shenzhen, fell by 25% in 2018, but has recovered by 9% so far this year. Emerging markets are particular beneficiaries of looser US monetary policy because this reduces the cost of financing borrowings denominated in the US currency. It also tends to reduce the value of the dollar, so reducing the effective amount of borrowings outstanding. Another reason why investors have returned to Chinese stocks is valuation. At the beginning of February, the CSI 300 was valued at just 11 times the previous year's earnings. That's much cheaper rating than that enjoyed by shares in developed markets like Wall Street. The big story in the UK, naturally, remains Brexit, with the clock ticking down to exit day at the end of March. There are now fewer than 50 days until Britain's departure from the EU, in the absence of a deal being agreed by the UK's divided parliament. With Mrs May now dependent on persuading enough Labour MPs to support her withdrawal agreement to neutralise the hardline Eurosceptics in her own party, Jeremy Corbyn's ambiguous approach to Brexit has come into focus. The official line from Labour is that it will support the government if a list of 5 criteria are met. The most important of these is membership of a permanent customs union with the EU. Unfortunately, this is also the least likely to get the nod from number 10, because it would limit the ability of Britain to strike its own trade deals with third-party countries in future. This is one of Theresa May's red lines. Meanwhile, the stakes being played for by the two main parties have been laid bare by the Institute for Fiscal Studies, which said this week that Britain would have to endure another 2 years of austerity to plug the hole in the public finances that would result from a disorderly Brexit. The government has already said that a no-deal exit would leave public borrowing £50 billion higher in 15 years' time than if Britain stays in the EU, but the IFS thinks that even this projection might be too optimistic. Finally, on the corporate front, earnings season continues on both sides of the Atlantic. Results from chipmaker Nvidia are worth watching for indications of where next for the tech sector. The company warned last month that fourth quarter revenue would be lower than forecast. Elsewhere, industrials are in focus as the trade talks continue, with numbers due from Bombardier, Deere & Co, Nissan and Michelin. The consumer side of the economy is represented by Hyatt, Coca-Cola, Pepsi, Kraft Heinz and Nescafe.